Hey there, everybody. Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Today, we are going to think specifically about these recent, very large short put synthetic long stock trades and why, in particular, I think that they offer some evidence that some larger players, certainly potentially institutional players, may support our understanding of this 2x net asset value floor on GameStop. So that's coming up today. Before we get into that, we do go to our gratitude. Today's gratitude goes out once again to Adam Graff, Amgo Blue, as well as to our monthly supporters, Not Medical Advice, Cosmotropic, and Faithless Looter. Thank you very much, right, to them for helping offset some of my data expenses on a regular basis, as well as to everyone who has supported in the past and will support going forward. You guys all help make my efforts here, both in research and publication, possible, and help me reach out and reach more of the GME investment community. So thank you very much for your support. Main topic today, we are going to think about this synthetic long stock trade, otherwise known as so it's a short put trade that can be thought of. It's so far in the money, we might think about it or think of it as a synthetic long stock trade. So number one, why is this the case? Why would a short put trade be considered a synthetic long stock trade? Well, with puts like this, so like we can see, right, we had another, so yesterday we had, like close to like 30 something million in volume on these short put trades today, like another 10 million in these things. And what we've been seeing is this is a continuation of the types of trades that we saw back on, when was this? This would have been the 6th and the 7th of May. So 6th and the 7th of May, right before we started moving up pretty dynamically to the upside, we saw tons of short puts come in, basically from, I think the lowest ones we saw at that point were 95, and they went up to maybe 105. We're seeing 110s, 100s, 90s, 85s, 105s, just kind of everything that's like way, way up there. Any sort of one delta in the money put. So why is this considered a synthetic long stock trade? Well, part of this is because it is these contracts, these puts are essentially one delta. They're either one delta or they're very, very close to being one delta. I think honestly, even the 85s are one delta. I'll just do a quick check here. So these are all out in January. And I will do a quick check on the delta. Even if we go to the lowest one, which is something like an 85 delta. Well, okay, so they're the inverse. So so even the 85s are their 0.09 delta. Those are calls. Sorry. Yeah, they're -1. They're -1. So from 65 up, sorry, I was looking at the call side. So from the put side, right? So they're negative, starting from 65 all the way up. These are -1. These are -1 delta. So when you short them, if you short a -1 delta put, then you are long 1 delta. So 100 deltas, right? 100 units of delta on your books, right? So that is essentially that is the same in terms of delta. Being long 100 shares of the underlying. If you have 100 delta on your books, that's the same as being long 100 shares of the underlying. So wait a second. Why would you as a trader want to do that? Like, why not go and just buy the 100 shares? Doesn't it kind of work out to be the same? And in certain respects, sort of in the immediate sort of fray, so as that comes together, yes, but not in terms of what you are then capable of doing in terms of hedging and what the market mechanical impact of that trade would be. So we'll break down what I mean by these now. So what do I mean by market mechanical? Like, okay, if you go out and you put in a limit buy and you buy 100 shares, you essentially engage in a trade with the equities market maker. In this case, for GameStop, this is Citadel Securities. You go ahead and enter into a trade with them. It may be their asset management arm. I actually forget, but it's either securities or the asset management. But in any case, they're the GameStop equities market maker. You are issued 100 shares, right? Let's say you buy 100 shares. You get 100 shares. 100 shares go on your books. and that's it. Then it's up to Citadel to go ahead and settle that trade, which they can fail to deliver that trade, right? They can IOU you, right? They can say, oh yes, we filled the trade, but then not actually have the shares, like not actually deliver the physical shares to you, in the sense that they don't settle that trade. They never had the shares to give to you, but they are expected, based on the DTCC rules, they are permitted to essentially fill your trade. They're permitted to issue you a kind of synthetic share, and then they're granted a certain amount of time to go ahead and locate that share for settlement purposes, so long as they were, quote, engaged in bona fide market making activities, which, as the market maker for GameStop, they can say, well, yes, someone came and wanted this trade. So it's our duty as the market maker to provide liquidity. Therefore, we completed the trade, but for one reason or another, could not so happen to settle the trade within a period of time. So, we went to an ETF and created a series of shares, got this, the ETF bought them, but then the authorized participant may have ended up failing those, right? There's a whole thing that then can go into, settlement limbo, this kind of internalization. Okay. So what does that practically mean for GameStop? This happens a lot. We see this especially with the very high levels of dark pool activity that we see. Not so common with smaller share numbers, but right, they don't really affect the price that much, even if they were to go to the lit market. But let's say you wanted to go ahead and purchase, $5 to $7 million worth of shares. All right, that's a big order. There's no way that Citadel is going to let that come onto the lit market. They're going to internalize that. That's going to a dark pool where they can fudge it, and then they can do their ETF stuff, and then they can allow the volume to come onto the tape at a time of their choosing, when it would be convenient for them, right? Okay. But let's say that you instead undertake this short put trade. You're going with this synthetic long stock trade. First off, now you are now not dealing with the equities market maker. You are now dealing with the options market maker. The options market maker will facilitate this trade regardless of how advantageous or disadvantageous the trade is to them. They will do this, and they will dynamically hedge this trade in order to ensure that this ends up being in their favor. So largely, it's my understanding and my working theory based on how I trade as well, that options market makers are largely profitable because, right, they'll take basically any trade you offer them, because on the whole, the majority of trades that are offered to them are statistically in their favor. That's not true of every trade, but on the whole, they take every trade because they know, so long as they just facilitate volumes of trades, the distribution of trades into categories which are in their favor versus those that are not, are overall on the whole statistically in their favor. So all they need to do is just have the volume flow through. They just need to have more volume, and the more volume of options trades, the more profitable they will be, right? So this works exactly like a casino. I've explained this before. Some months ago we kind of talked through this, but the idea is just volume. A casino just wants volume. That's why they do shows. That's why they do the restaurants. That's why they bring you in. That's why if you're a really high roller too, like they'll just give you free stuff, because the idea is like come in, play, and the more you play, the more they can get you to play, the more times they get you pulling the lever, whatever it is, or taking another hand of cards. If they just up volume, they know the statistics, they know the probabilities are in their favor across the full iterative series of games, that as long as volume goes up, they will profit. And the more they profit, the more volume, the more profit. That's how that works. So that's largely how the options market maker operates. Okay, so you're engaging in this trade, even though it may not strictly be in the favor of the options market maker. They're also going to hedge how much it may not be in their favor by doing this whole dynamic hedging. So if you're selling them a -1 delta contract, that means they have to go out and they're going to go out and hedge that by purchasing shares of the stock. So this creates a different sort of market mechanical, right? You're engaging with a different structural party here. You're engaging with, in the case of GameStop, Wolverine Trading, who's going to go out on the lit market. Now, typically, this is what they're supposed to do as the market maker. They're supposed to go out and then purchase those shares on the lit market in order to hedge those contracts. So now they have as a hedge those shares on their book, and they had to purchase them on the lit market. Okay, so already from a market mechanical perspective, if you're selling that short put, that one delta, that negative one delta short put, versus buying the equivalent shares of stock, you're decreasing the odds, you're decreasing the chance that your order is going to be internalized, right? So part of the problem with just going out and buying a whole bunch of stock is you're like, okay, I'd like to buy this because I'd like the the value of the underlying to appreciate, and then to profit off of my delta exposure to the underlying. But and you think, right, when you're a big enough player, I'm going to put this order in. You can see people talk about this like this. They think in these terms, especially buyers. I mean, I remember this back during the sneeze time too. People think in these terms. Oh, if just buying volume comes in, it'll move the stock. We need more buyers, more buyers, more buyers. In fact, that's how like pump and dumps work with like penny stocks, because they're so low liquidity that very small sums of money can really appreciate the price. But the thing about something like this, right, on these larger stocks, right, how this works, how market making works, the trade can be internalized, and it can affect, like it will at some point, it has to affect the price of the stock. But it can be bounced around to a negotiable date sometime in the future, right? So you hear Warren Kitty talk about this, right? Anybody who is short is a future buyer, right? Someone who has sold but not yet purchased a stock is just merely a future buyer. The question is when. The question is when will they do that? You take out a lot of that if you're doing a synthetic long via this deep in the money short put. At least that's part of the idea there. Okay. However, there's another component to this, and that is that you have, as the short put writer in this case, you have a built-in downside hedge to your trade. So let's say you go out and buy stock. Okay. You're exposed to the upside, you're exposed to the downside, you're just exposed to positive delta. How do you hedge that position on your books as a trader? Well, very commonly, you could just go out and sell covered calls. I mean, a lot of my strategy involves basically taking advantage of volatility, arbitraging volatility, and some of the extrinsic value that's built into options, which are very heavily statistically in favor of the writing party, and using that essentially to generate, as a hedge over time for the change in delta value of my shares of the company, right? So essentially, I kind of amortize the share position by leveraging and deleveraging risk. Like that's right. That's how that goes with cover calls. Okay, now you can do that, right? But that does tend to require a more active management in order to be able to properly hedge the downside, right? Let's say you don't want to do that because that's intensive, and you're also worried about the market mechanic thing. If you go with this short put trade, you can't sell covered calls on top of that short put. But well, I mean, you could pursue multi-leg options trades, but it doesn't quite work the same way. But what you can do, right, because you don't actually have the shares as collateral, and you can't. It's not like having a long call, right? You have a long call, you can sell like a deep in the money, like you have a leaps contract. You can sell covered calls on that because you can exercise the leaps at will, but you can't exercise a short put at will. You can't just take the short put and then turn it into shares whenever you want, the way that you can a long call contract. So you can't really do that. That doesn't quite work. You would have to find a way you'd have to buy back the put, get your cash collateral back, and then buy shares, and it would be a whole thing. So it doesn't really work out like that in terms of the mechanics. But what you do have with a short put is you do have an interest rate hedge. So for this, I'm going to bring up a little image that I crafted myself here. Got into my internal artist right here. So so what we have here is just some basic numbers on this trade. So basically, the past 2 days, we saw about $40 million in premium exchanged between the dealer and whoever it was that was trading these contracts. So basically, what happens, right? You have a cash secured put. You must have, let's see, you have to be perfectly hedged. You must have in your account, you must have the cash for that position in your account as collateral. Okay, and that way, if you are assigned, you have the cash, you actually have the money to go out and purchase the shares required in order to make good on this obligation, on this delivery obligation. Okay. So you Okay, so what you'll do, right? Let's say you're selling, let's say the average cost is it's like 100, 100 put or something like that. Strike price is 100. So you've got to have, let's say $28 per share. So you got to have 2,800 per contract on your in your account, because that's the price of the shares. And then you're getting 8,200. It's one delta. These things are basically these are all intrinsic value at this point. So you're getting $8,200 in credit into your account per contract that you sell. So, maybe this is 5 million. Maybe this is probably closer to 7 million. I sort of thought about this a little bit. It's probably closer to 7 million in total stock. So let's say 7 million in the account, and then you get 40 million in credit. Okay. So because you're the writing party, like you already have this cash in your account. You're not handing this cash to anybody. That's just sitting there. Okay. It gets locked. You can't take that cash and do something else with it. It gets locked up. It gets moved into like a money market mutual fund, or something like that, or you collect interest on it. It just sits there in your account, but you collect interest on it. Then you get 40 million in credit from writing these puts. Okay, so now you have 45 to 47 million. Let's say 45, 47 million in your account. It's locked. You're not out this money, but you don't have it, right? But it does sit on your books. And while it sits on your books, it's collecting 4% interest based on what the federal funds rate is. All right. Now, the market maker then goes out and actually buys your shares. The market maker takes another 5 million, buys your shares, and holds those shares on his books. Okay, so he'll take that, 5 or 7 or whatever it is. He'll go out, he'll buy the shares, right? He'll buy those GameStop shares. He'll buy 7 million in GameStop shares at $28 and hold that on his books as a hedge for now all of these long puts that he has. So he's delta neutral. Okay, but on his books are all of these long puts, and now this $5 to $7 million share hedge. But on your books as the trader, you've got your original 5 to 7 million in cash that you would have gone out to buy shares with. You can't do anything with it. That's got to sit in your account. It's collateral. But now you've also got another 40 million as collateral. So you've got 45 to 50 million in collateral that's sitting in your account. Okay, collecting interest, collecting the federal funds rate, essentially. Okay, so rather than now just holding these shares, which then you could actively manage and leverage by selling covered calls if you just went out and bought the shares. Instead, the shares sit on somebody else's books, sits on the market maker's books as a hedge for the long puts they have that you sold them. And now you have the money from them that they use to buy those puts from you, sitting on your books, locked up, collecting the interest rate. Okay, so why does that matter? Well, okay, you're now essentially only 5 to 7 million of that cash is actually yours right now. That other 40 million is money that you received as a credit from the market maker, but you yourself are collecting interest on the whole thing. So for a mere 5 million in collateral, you're now collecting the interest equivalent of 45 million. You're collecting 4% on 45 million. So you've essentially leveraged that 5 million, the interest, that 5 million into the interest on 45 million. Well, that's pretty big, right? So now you're essentially collecting, 20 or 30% on this. I think it's closer to 7. So I think this should work out to be like 4 or 5 times leverage rather than like 8 or 9. I'd have to actually go through and you got to look and actually do what was the total sum of the value of shares and deduct them from all the different strike prices. It's a little hard because they were all at different strike prices, but it should be about 5, let's say about 5x leverage. Maybe even 6 for the 125s. It would be closer to 6. So you're at $28. Okay. So if the price of the underlying, right, you're exposed. If the price of the underlying goes down, right, that's really where a short put is exposed. If the price of the underlying goes down, you will lose on that trade according to how much the underlying decreases. So it's a 1 delta item. You lose at the rate at which the underlying depreciates at a 1-to-1 rate. Okay. But because in 7 months, right, this will be over 7 months, these expire in January, you'll collect 4%, right? You'll collect let's say if it's on this this 45 million, you'll collect something like be like two and change percent. So that would be close. That'd be around $1 million. So you'd be around $1 million. It'd be 2 and change of this, but $1 million is about 20% of this 5 million. Or even if you say conservatively, it's closer to like 12% of that 7 million. Deduct 12% from the underlying, from the price that you entered these, $28 or thereabouts. And what price do you get to? You take off even 10%, you're taking off $2.80. Deduct 12%, something a little bit over $3. So now you're down to around 25, right? So even if you're collecting, even if it's only end up being 10% on your original collateral, at 28, you're down to 25.20, which is essentially that 2x net asset value floor that we've been talking about as our lower bound on GameStop, right? With all of this new cash they've had on hand from last year's at the market offerings and the convertible bond offering. So what this means is you are now long the equivalent number of shares of GameStop. Let's say you're long, you get to be long 5 million in GameStop shares. But you don't, in exchange for not having the shares on your books, you get all of this cash to go on your books, which serves as a token by which you can collect interest rate premium as a hedge on the downside. So what this particular trade suggests is that if this particular trader believes that the net asset value floor of GameStop is a lower bound on GameStop's price range over the next 7 months, this trader cannot lose money on this trade. This trader can lose potential maximum return. Some pathways are less profitable than others, but basically this trade, as long as that 2x net asset value floor remains intact, it's impossible for this trader to lose money unless the interest rate goes down like a ton, which might, right? We do see some cuts coming up later in the year, but even still, if we get some cuts and the interest rate goes down to 3.5, I mean, I think that's why, right? This is the original collateral amount is collecting. It's more than 10. It should be around 12 and 14%. So even if the interest rate goes down later in the year, it should still cover basically all of the way down to the net asset value floor. And if it doesn't, if there are no cuts, I mean there are cuts expected, then it should still work out in terms of being hedged to the downside. So right, your upside is potentially as high as GameStop. Basically, I mean, so your upside is capped. The exchange for that is if GameStop goes above the strike price, you don't collect more money over the strike price. Right. So if for those 100 puts, if GameStop's price goes over 100, if in January it's over $100, you don't collect any money over that $100. You keep the full premium, but you don't collect any money over the premium amount beyond the interest rate. For 125, it's not over 125. For the 90s, it's not over 90. So you do sacrifice, you essentially sacrifice unlimited upside, but you get this basically this built-in interest rate hedge, which makes your downside a little bit more appealing. And right, if you've invested this knowledge, if you have this knowledge investment into an understanding and a modeling of the value of GameStop shares as fundamentally not less than 2 times the net asset value of the company, then you effectively have no downside from this position. Right, that's what you're saying. You're guaranteed some form of positive return, or at the absolute very least, no loss. But certainly, your odds of positive return in some capacity are pretty good. So that's basically, as I understand, this trade. Somebody very big sees this, as pretty appealing. And in the past 2 weeks, so on the 6th and the 7th, and then yesterday, I should say 2 days ago, so Monday and Tuesday of this week, being the 19th and the 20th, has decided to probably, it looks like an investment. The previous week was about 6.8 million. So I think altogether, it's probably coming close to about 15 million. So rather than purchase 15 million shares of stock, this particular trader, whoever this is, or maybe it's multiple traders all combined, but this trade has leveraged about 15 million in cash into an additional 80 million in credit. So leverage this 15 million in cash essentially into that 15 million plus this interest rate, this 4% interest rate, annualized interest rate hedge on about 80 million in cash, together with exposure to appreciation in the GameStop underlying up to a share price between $90 and $125. Not a bad trade, right? So this actually illustrates a really interesting concept, and it's essentially something that I talk about with my trades all the time when I talk to folks. When we talk in the live streams, the art here of trading, and especially understanding proper options trading, is understanding ways and understanding how different options instruments at different times allow you to separate and wager different components of the standard investment in some sort of security. So in particular, the most important one to leverage is what finite amount of profit for a very specifically delineated amount of risk can you leverage, or can you wager infinite upside for, right? So every share technically has infinite upside, okay? Right, and this is something that a lot of the folks, right, a lot of the MOAS folks, Pake, right, wonderful, right? I mean, it's wonderful to be excited about the stock and this dimension of it, right? And it's certainly something that I don't, banish from my own understanding or calculation about how I understand the fundamental investment in GameStop here. But in terms of how I approach options, right, I essentially think about this in terms of what can I get for trading that infinite upside for a delineated period of time, right? How much money will someone pay me now to sell them the right, not to all of the upside, but to the infinite upside after a certain point, right? So essentially, like when you sell a covered call, let's say you're selling a covered call at $35. What you're selling is you're saying, let's say it's a June OPEX $35 covered call. You have 100 shares of GameStop and you sell that call. I think they're going for like $1.15, meaning $115. What you're saying is you're selling someone the right to GameStop's infinite upside above $35 in the span of time between now and June 20th. That's what you're selling them. You're selling them that for $115. And so your bet is when you're making that bet, I bet that GameStop will not appreciate an infinite amount between now and June 20th. And the person who's giving you $115 is going, no, you know what? I would prefer to give you $115 now to have that infinite right, to have the right to infinite profit above $35 in that span of time. You can understand, right, who has the probabilistic advantage there, right? So basically, options trading is understanding how to do that, understanding how to compartmentalize or use different instruments in order to break off pieces of that investment and transform certain undefined potentials into realized profits. That's how that's going, right? So you're making these types of trades, and some people want that, right? It's not always just like, in terms of being an options trader, right? You're not actually trading with other people. You're just trading with the options market makers. So they're largely facilitating this by necessity in order to have their full market making project responsibility basically permitted. So they're if you do that, right, they're probably just they're essentially using your trades in their own kind of risk management model. So even if they have losses on your trades, it fits within their grand scheme. So the returns for them for facilitating your losing trades allows them the ability to facilitate a far greater number of winning trades in their advantage as a part of their role as options market makers. So it doesn't really affect them in a meaningful way. But in any case, right, that's really what's underlying this particular trade here. And we spent a good amount of time thinking about that today. But it is important to think about that in the context of how we might understand GameStop's price action. We don't have a lot of movement otherwise in our options data. I would say the presence of that type of trade was the most important. It did look like yesterday, right? So we had more stability in the broader market. It does look like we might have, if we don't see call flows come in today in the broader market, we may see a bit of a depression into the end of the week, given that, as we can see here, right? So 523 weekly expiry is on the bear side. It is on the put dominant side. So if we become sort of unpinned from this gamma rich environment today, then we might slide a little bit down into that before coming back up into June OPEX. Yesterday, right, largely, even though very low volume, 4.7 million, we traded up on what looked to be a VWAP order. Basically, throughout the whole day, we had a little pop there at the 1:45 p.m. swap clear margin deadline. Looked like maybe some shorting to kind of keep the price down low enough to accommodate this margin call. Maybe some of it was used here, but then this looked like it was the closing out of a short position. Either this or, right, because we got right back up to here. So looked like maybe closing out this, whatever brought us down here into this V-shaped pattern, right? V-shaped patterns often tell us, especially in GameStop, when someone is closing out a short position. Technical still looking stable. Liquidity is very interesting. We do see GameStop shares available to borrow getting lower. So GameStop shares available to borrow getting lower typically corresponds to increased volatility, right? Decreased liquidity equals increased volatility. Decreased volatility equals increased liquidity. Or increased liquidity equals decreased volatility. So liquidity is going down now. 3 million is the lowest we've seen in some weeks, right down off that 52-week high. So very interesting. Still a respectable amount of shares that could be used to adjust the price, but interesting to see these sort of declining precipitously, despite the fact that the price is not being seriously adjusted downward. Volatility ticking up a little bit, not as high as it was basically throughout last week. We can see June OPEX back up over 90%, which is interesting to see. Not a lot of options activity, mostly ask skewed, but only moderately. Really important trades, I guess, again, were this synthetic long stock trade. Gamma exposure environment also not really changed, looking continued trading in this pocket here. So, I mean, sort of generic comments here in the sense that, someone can use the shares to adjust us downward, although that hasn't happened recently. We may still, right, and we do project in terms of our settlement deadline estimations to be looking at potential settlement today, tomorrow, maybe even into Thursday, possibly related to FTDs, XRT FTDs, and CAT errors from mid-April. Potentially, right, Richard Newton's been talking about this recently, so definitely hop over and check out his channel, check out his recent videos on possible OPEX tailwinds, so T plus 33 trading days. He's been talking about that quite a bit, so definitely go give that a look-see. And but I would say that the continued presence, even though a little bit smaller, yesterday versus Monday, of this synthetic long stock trade, these short puts, deep in the money short puts, I would say that the presence of that, the continued presence of that, has seeing that has occurred prior to considerable volatility in GameStop, volume in GameStop, and sizable price appreciation. So continuing to observe this, continuing to monitor this, staying wary of what's going on with our lending pool, but by and large, still seeing some pretty positive signs here. Technical and option stuff is pretty, ranging from just sort of stable to certainly bullish with those big those big short put trades, synthetic long stock trades coming in. So very interesting, guys. If you like that discussion, if you like that concept breakdown, be sure to let me know in the comments. Leave questions if you had them. We can always break some more of this down on this week's live stream coming up on Friday at 10 p.m. 4 p.m. Eastern Daylight Time after market close. So looking forward to seeing you guys then. Looking forward to see you tomorrow as well as we have our next video breakdown. So thanks very much, you guys. We'll see you next time. Take care.